Greetings again, and thank you for investing your time in your own success. And hopefully we'll be successful in helping you understand reading financials and understanding accounting. Our third element in Module 6, we started talking about this LIFO reserve and the footnotes. So we're going to go a little deeper dive into that because I want to make sure you have a clean understanding. So in the footnotes themselves, it tells the story. A couple of things besides telling you whether to do LIFO, FIFO, there's an analysis called the LCM Rule, or lower of cost or market. You know, our conservative accountants, we're the ones that say, I don't want to overvalue my inventory. I don't want to overvalue my assets. I don't want to undervalue my expenses, and I don't want to overstate my income. So that's the conservatism kicking in gear. So what happens if we have wine that we sell? We're a wine store. And we have 5-year-old wine and 10-year-old wine and 15-year-old wine and 20-year-old wine. And we hope that the older the wine gets, the finer vintages, they actually get better with age. But not all wine gets better with age. You were in undergrad, you probably had wine that might have not aged gracefully, and it turned to vinegar. So what does that mean? Well, it turns to vinegar, it's not worth the price of, well, what wine is. Unless you like wine vinegar, but that's not nearly as expensive as a bottle of wine typically. So we're looking at that saying, I got a value on my balance sheet, the lower of the cost or the market. And if the market value decreases, if it's obsolete, if it gets damaged, if it's broken, if it's equipment, if it's machinery, whatever it is, you're going to have the lowest value that you can. So for example, Home Depot happens to use FIFO, first in, first out. At the end of the period, they compare the ending FIFO balances with the market value, replacement cost, and writes down inventory if the cost is less than market value. This non-cash expense is put into cost of goods sold. So it's direct expensing to cost of goods sold. Reduce the inventory, increase the cost of goods sold. That reduces the profit. Equity gets lower because retained earnings drop. And so inventory drops, our equity drops, and we stay in balance. But we have to have the lower valuation. We need to take the hit. We'll talk more about impairments in the future. Same thing. We take a hit on assets when they become impaired. How about the adjustment for the LIFO reserve? So we have this LIFO inventory plus LIFO reserve to get to FIFO inventory. We said, by the rules of GAAP, by the powers of GAAP, we must include a LIFO reserve if we're using the LIFO method, so we can get some comparable statements of somebody using FIFO. And we saw how significant inventory valuation can be. We also saw how significant using LIFO versus FIFO can be, like a 20% difference in the example they gave Caterpillar. In general, we make 3 adjustments to convert LIFO to FIFO. Increase inventories by the LIFO reserve, increase the tax liabilities by a tax rate, and increase retained earnings by the difference. For example, in Caterpillar's situation, increased inventory by $2 billion added to the LIFO reserve, increased tax liabilities by $693 million, and increased retained earnings by the difference. So we have to take into account these wonderful things called taxes. You all love taxes, I know. We're going down that path. So the following equation, FIFO cost of goods sold equals LIFO cost of goods sold minus the increase in LIFO reserve, or plus the decrease. This probably won't get tested, so don't just close your ears, but I want to make you aware of it, that this is the kind of stuff that as accountants, we review this and we want to make sense of financials. And then when we're investing or making decisions based on the financial statements, we now need to have these adjustments kick into. And here we disclose it. The tables, they're all part of the footnotes, and they tell you what they did. They tell you how they did it, where they stand. Let's talk about LIFO liquidation. And I touched on that with that gas example, the gas tank with 1,000 gallons. In an inflationary environment, sales of older pools will boost gross profit. Lower costs are matched against current selling prices in the income statement. This is called a LIFO liquidation. And that gets described because when numbers like that are out of whack, investors are going to look at those numbers and say, can this be real? Is this the reality? What's going on here? Then we look at that and say, oh, there's an explanation. In the footnotes, yeah, you got to read them. You want to read them, and we're going to read them. They make sense. They help make sense of where the numbers are coming from, even if something, because of GAAP, is distorting things. That gives us more on the LIFO Reserve. Again, wanted to give you a flavor, a taste, and understanding. So I'm going to go ahead and end the video here. We'll go on to Module D.